Today, the Bears are in town. Hello, I'm Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 25th of August 2018, our digest of the latest finance and property news with a distinctively Australian flavour. And what a week it was. But by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. Here is the link, and it's also in the comments below. So Scott Morrison, the new PM, must carry much of the burden for our current economic situation, which, to my mind, is sliding by the day. Booming debt and flat wages have combined to drag home prices lower as the number of SMEs feeling the pressure continues to rise. Spruiking high jobs growth, measured on a simplistic basis which does not report underemployment accurately, and in an environment where the CPI for real households is much higher than the quoted number, means that the GDP is likely to flag, as the Aussie continues to slide against the US. The Bears are, it seems, out in force now, and you can watch my discussion with John Adams, recorded before the spill, Is Parliament Fiddling While Rome Burns, for the political context. Now, we expect some unnatural acts from the new man, perhaps with first-time buyers offered the chance to tip their super into buying property, and probably overt attempts to trim migration ahead of the election. Remember that Morrison spent time at the Property Council, so he is, so to speak, pro-property and pro-property investment. Thus, the debt bubble may grow further and investors may be enticed back, at least to some extent. This means a harder fall if or when Labour sweeps to power, as the property market turns to custard. What a nice incoming present. And analysts seem to agree the Bears are out. For example, Damien Bowie at Credit Suisse says that in the year to 2017, the Australian population grew by around 388,000 people to around 24.7 million persons. According to the 2016 census, the average number of people per household was 2.57. Assuming this number remained steady throughout 2017, an optimistic assumption, household formation was about 150,000, which is the 388,000 divided by 2.57. Now, it is possible for replacement housing demand to rise as high as around 25,000 per annum. Therefore, an optimistic assessment of underlying housing demand is around 175,000 per annum. This is below the current level of dwelling completions, which is around 210,000 per annum. In other words, Australia is in the situation of marginal housing oversupply to the tune of around 35,000 per annum. Consistent with this state, house prices, he says, are falling moderately. However, it is now possible that marginal oversupply could become worse due to changes in the political climate. For example, former Prime Minister Abbott, representing the shadow Conservative wing of the ruling Liberal Party, has advocated in the past that he would like to cut immigration by up to 80,000 per annum. If the immigration intake is cut by 80,000 per annum, household formation would fall to 119,000 per annum, and underlying housing demand would fall to 144,000 per annum. At the current level of dwelling completions, this would increase marginal housing oversupply to around 65,000 per annum, consistent with much faster home price declines. And on top of this, he says, we need to consider the risk that if the Liberal Party loses the next election and the Labour government wins, the new government would attempt to grandfather out negative gearing provisions for investment properties. Now, BOE does not include the tighter credit environment and high debt, which is, as we discussed in this week's live stream event, are crimping households' ability to borrow. In fact, this is the strongest negative impact on home prices in our view, which is why we've revised down our 4 economic scenarios such that we think there is now only a 5% probability of the RBA's forecast for the economy playing out as they think it will. All our other scenarios are more bearish. And you can watch the full event on YouTube, including the chat during the session. And we had more than 300 watch live on Tuesday. Our next event, by the way, will be on the 18th of September at 8 p.m. Sydney, and it's already scheduled on the channel if you want to set a reminder. We expect the next RBA rate move to be down, not up. Whilst both Barclays and RBS this week pushed out their expectation of a potential cash rate rise from the RBA due to weaker economic conditions to late 2019 or 2020. Home prices continue to run lower, as the latest data from CoreLogic shows, with year-to-date falls of 3.44% in Sydney and 3.29% in Melbourne, plus a fall of 1.95% in Perth. But also of note is that prices are now falling faster in Melbourne, down 0.59% this month so far, compared with 0.23% in Sydney. And auction clearance rates continue to languish as more properties remain on the books for sale. Of course, values are still up 35.3% since the 2010 peak at the 5-city level, driven overwhelmingly by exceptionally strong gains in Sydney at 58.5% and Melbourne at 40.4%. But there has been little movement elsewhere, and in fact, if you take inflation into account, real prices have fallen. And remember that the CoreLogic index is driven by settlement data, which is weeks behind transactions themselves. CoreLogic also showed that as well as fewer 7-figure sales occurring now as values decline, the volume of more affordable homes selling is also falling. Their analysis shows that the share of sales under $400,000 has continued to decline over the past year. Nationally, 29.2% of all houses and 34.6% of all units sold over the 2017-18 financial year were for transactions less than $400,000. The share of sales below this price point has fallen from 30.7% for homes and 35.4% for units a year earlier. And the share of sales below $400,000 has increased slightly over the past few months for both houses and units. A historic low 13.9% of combined capital city house sales and 25.8% of capital city units were under $400,000 over the 2017-18 financial year. The share of sales below $400,000 has fallen over the year from 16.2% of houses and 27.1% of units. Although capital city dwelling values are falling, there continues to be fewer sales occurring below that $400,000 threshold. The share of sales below $400,000 is predictably much larger across regional areas of the country than within the capital cities. And over the latest financial year, 49.6% of all regional house sales and 57.3% of all unit sales were for less than $400,000. House sales under $400,000 were at a record low and down from 51.6% the previous year, while unit sales under $400,000 have increased over recent months, but are lower than the 58% a year earlier. Then consider falling rental yields. The AFR reported that Andreas Lundberg from Montgomery Investment Management believes that the sagging yield on residential rental properties in Sydney could drive prices lower if investors seek higher yields without an increase in rents. Sluggish rental growth is weakening the income-generating prospects of property, giving buyers another reason to avoid the asset class, and potentially forcing prices to fall further. Such a derating of residential property, they say, is not out of the realm of possibility. In a rational market, rental yield should drift higher. But we don't think it's a rational market, he said. With official data showing property rental yields in Sydney are about 2.7%, well below the long-term average of 4%. In an environment where rates are no longer falling and indebtedness is very high, rental yields should become a more important consideration in where you should invest your money, he said. If you look at Sydney, the annual fall in rental rates is significant according to CoreLogic data. This is one reason why property investors are and will continue to head for the exits. Rental yields remain the lowest in Melbourne at 3.04% and Sydney at 3.21%, which, given the dim prospects of capital growth and tougher credit conditions, is likely to act as a further disincentive for investors to buy in these markets. And that will help push prices even lower. And Labor's proposed negative gearing and capital gains tax reforms will also add to the downward pressures. We discussed the state of the property market in a pre-record for Nine's 60 Minutes programme, which will be broadcast in a few weeks. And you can see our video blog, which tells the story of the day's filming, Talking Finance and Property, on Channel 9. Building company Lend-Lease, in their results, which were strong, specifically called out that they were preparing for Australia's housing slowdown. We have been participating in a slowdown for some time, and most markets are past their peak, the group chief executive Steve McCann said. Pre-sold lots in its big residential communities slowed to 3,231 lots in the financial year 2018 from 3,896 in the previous corresponding year. Their share price is off its highs, but up 24% over the past year, as building approvals are still pretty strong. Perhaps Lend-Lease market share is lower here now. That said, they're still holding a huge land bank and have diversified from residential building, so they can afford to wait for the next property boom down the track. Westpac's quarterly update was a salutary lesson in what's happening in their mortgage book. The biggest property investor lender in the country reported that its net interest margin in the June quarter 2018 was 2.06% compared with 2.17% in the first half. The 11 basis point decline mostly reflected higher funding costs and a lower contribution from the group's treasury. We discussed this in more detail in our post Through the Westpac Looking Glass. But the primary source of higher funding costs has been the rise in short-term wholesale funding costs as the bank bill swap rate, the BBSW, increased sharply from February. Every 5 basis point movement in the BBSW impacts the group's margins by around 1 basis point. And compared to the first half of 2018, the BBSW was on average 24 basis points higher in the third quarter, so reducing the group's net interest margin by 5 basis points. As well as reduced treasury activity of 4 basis points, 2 basis points came from the ongoing changes in the mix of the mortgage portfolio, less interest-only lending, along with lower rates on new mortgages. Deposit pricing changes only had a small impact on their margins in the third quarter. And finally, while overall credit quality was fine, mortgage 90-day plus day delinquencies in Australia was up 3 basis points over the 3 months ending June 2018, with most states recording a rise. So we see the pincer movements at work: deep discounting to try to attract new business, a switch from interest-only loans, thus reducing interest take, a hike in funding costs and higher delinquencies. Combined, these forces are enough to put considerable pressure on the bank as well as others in the sector. Their share price fell 2.43% on Friday to 27.66, just above their 12-month low of 27.30 in June. And we see more downside than upside in the banking sector. And remember, the Royal Commission is still grinding away. In comparison, CBA, the largest owner-occupied lender, was up 0.2% to 70.89 on Friday. And the ASX 200 ended the week at 6,247, up a little on Friday after the ructions in Canberra this week, but below its recent highs. Again, we see more downside than upside. The Aussie against the US dollar ended at 73.26, up 1.08% on Friday. Looking at the daily chart, there was a 1-point climb back into its familiar consolidation range from June. By the close of play, it remains right on the May 2017 low. And there was also its largest daily gain since the 4th of June. From a bigger picture, its dominant downtrend since February still remains in play. But for now, the pair may consolidate between near-term resistance and support. The former is around 73.82 or the August 21 high. A push above that exposes a descending resistance line. The former is around 73.82 or the August 21 high. A push above that exposes a descending resistance line composed of the July and August highs. This line also intersects the February trend, making for a potentially stubborn area of resistance. In the event the Aussie dollar pushes above that and potentially reverses its significant progress to the downside, we may eventually get to the June 6th high of 76.77. On the other hand, immediate support is at 72.38, which is the low set on Friday. A descent under that then exposes the current 2018 low at 72.03. Continuation of the Aussie dollar US dominant downtrend would then involve getting beyond the December-May 2016 lows between 71.60 and 71.45, and we think the longer-term trajectory will be lower as the local economy slows further. The risk is there to go below 70 cents ahead. Across to the US markets, where the bull market is still running. The Dow Jones Industrial ended up 0.52% to 25,790, up 0.52% on Friday, still below its February highs. But the benchmark S&P 500 stock index clinched its longest bull market run on Friday, closing above its previous January high, as Federal Reserve Chairman Jerome Powell affirmed the US Central Bank's current pace of rate hikes. The S&P had last reached a new closing high on January the 26th, then retreated more than 10%, a correction that lasted until February the 8th. Friday's new closing high confirmed that the index bull run remains intact. Speaking at a research symposium in Jackson Hole, Wyoming, Powell said that the Fed's gradual interest rate hikes were the best way to protect the economic recovery, maintain strong job growth, and keep inflation under control. His comments did little to change market expectations of a rate hike in September and perhaps again in December. Investors said that they were reassured that Powell's comments stayed in line with previous commentary from the Fed regarding policy. Economic data also boosted sentiment. New orders for key US-made capital goods increased more than expected in July, and shipments growth held firm, the Commerce Department said. The index was up 0.62% to 2,875. However, housing numbers continue to give the market pause. It's recently been the part of the economy waving the most red flags. Data on existing home sales released by the National Association of Realtors on Wednesday showed a surprising drop. Existing home sales fell 0.7% in July from the previous month to an annualized pace of 5.34 million units. Now, economists had forecast a 0.6% increase to an annualized pace of 5.44 million. Sales are now 1.5% below a year ago and have fallen on an annual basis for 5 straight months, according to the NAR, especially at the lower end of the market. The report also showed that the median existing home price for all housing types in July was $269,600, up 4.5% from July 2017, when it was $258,100. July's price increase marks the 77th straight month of year-over-year gains. In addition, new home sales fell short, dropping to a 9-month low in July. New home sales fell 1.7% last month to an adjusted annual rate of 627,000. Economists expected a rise of 645,000 units. And Moody highlighted once again that at the late stage of a cyclical boom, there are signs of excessive risk-taking. This time, the most serious developing threat to the current cycle is lending to highly leveraged non-financial businesses. While businesses appear to be in good shape in aggregate, a significant number of highly leveraged companies are taking on sizable amounts of debt. And this is evident in the rapid growth of so-called leveraged loans, which are loans extended to companies that already have considerable debt. These loans tend to have floating rates, typically LIBOR plus a spread, with a below investment grade, BBB or less, rating. Leveraged loan volumes are setting records, and loans outstanding have increased at a double-digit pace over the past 5 years to nearly $1.4 trillion. Businesses use the loans to finance mergers and acquisitions and leverage buyouts, followed by refinancing and to pay for dividends, share purchases, and general expenses. Powering leveraged lending is demand from the collateral loan obligation market. The CLOs are leveraged loans that have been securitized, and global investors can't seem to get enough of them. This is clear from the thin spreads between CLO yields and comparable risk-free treasuries. Approximately 1/2 of leveraged loans currently being originated are packaged into CLOs, with CLO outstandings approaching $550 billion. To meet the strong demand for leveraged loans from the CLO market, lenders are easing their underwriting standards. According to the Federal Reserve's survey of senior loan officers at commercial banks, a net 15% of respondents say that they lowered their standards on commercial and industrial loans to large and medium-sized companies this quarter, compared with the previous quarter. The only other time loan officers eased as aggressively on a consistent basis was at the height of the euphoria leading up to the financial crisis in the mid-2000s. Considering the leveraged loan and junk corporate bond markets together, highly indebted non-financial companies now owe around $2.7 trillion. Their debts have been accumulating quickly as creditors have significantly eased underwriting standards. As interest rates rise, so too will financial pressure on these borrowers. Despite all this, global investors appear sanguine as credit spreads in the CLO and junk corporate bond markets are narrow by any historical standard. Regulators are undoubtedly nervous. They issued guidance to banks to rein in their leveraged lending in 2013, but an increasing amount of the most aggressive lending is being done by private equity, mezzanine debt, and other institutions outside the banking system, and therefore regulators' purview. Now consider that subprime mortgage debt outstanding was close to $3 trillion at its peak prior to the financial crisis. Insatiable demand by global investors for residential mortgage securities drove the demand for subprime mortgages, inducing lenders to steadily lower their underwriting standards. Subprime loans were adjustable rate, which became a problem in a rising rate environment, as borrowers did not have the wherewithal to make their growing mortgage repayments. Regulators were slow to respond, in part because they didn't have jurisdiction over the more egregious players. Now, it's too early to conclude that non-financial businesses will end the current cycle in the way subprime mortgage borrowers did the previous one, but even so, while there are significant differences between leverage lending and subprime mortgage lending, the similarities are, well, eerie. We're going to make a longer post later on this important issue, but it does highlight that even amid the booming US markets, the bears are stalking their prey. Finally, to round out our review, the fear index, the VIX, was lower, down 3.38% to 11.99 on Friday. Gold was higher, up 1.53% to 1,213, though still well down across the year. And Bitcoin ended the week at a slightly higher 6,722, up 3.5% on Friday, though just one day after the US Securities and Exchange Commission, the SEC, rejected proposed rule changes for 9 Bitcoin ETFs. The Commission initiated a review of all related decisions, and as a result, 3 rejection orders made on August the 22nd are now stayed, pending the review by the SEC Commission and the Commissioners. This is the first time the SEC initiated a review of its staff decisions on Bitcoin ETFs, and their initial rejections were driven by concerns about the underlying markets. So this just might indicate a change of view. Bitcoin, of course, is way off its highs of more than 18,000, but this might just signal a change in sentiment. We will see. So putting it all together, it looks to me as though the bears are indeed stalking the halls. Expect more downside in the months ahead. If you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. The link is in the comments below. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting that subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.